Hi there, this is Bikram from Margin Value. Namaste. Even though we have seen a massive correction in the stock market, not all sectors and not all stock may necessarily be cheap. When I say cheap, I mostly mean cheap relative to the historical valuation. But why I'm talking about historical valuation here? Historical valuation is relevant, historical valuation is important because valuation has this property that it reverts to its mean. When we look at this context of historical valuation, we will notice that many investors may have got hit with something called recency bias. They have seen massive spike in the asset prices, forgetting what has happened in the past, and they may have got carried away and bought stocks at wrong valuation, at very rich valuation, at very expensive valuation, and they may have got hit with the price risk. So we have to be careful when we talk about valuation. It's just not about current valuation. The current valuation has to be seen in the context of historical valuation. Now we are going to have a look at a couple of stocks from insurance sector that appear to be cheap. So here I am at marginvalue.com and I am going to look up General Insurance Corporation of India, and I will straight away head to the industry and sector insights, and then I am going to look up the top stocks in the insurance sector. So General Insurance Corporation of India and New India Assurance Company, these are two stocks that we are going to focus on. If you look in terms of if you look Now, if you look in terms of 52-week high, we see that this has corrected around 45% and this has corrected around 55%. Now, we have to be very careful when it comes to the stock price, and when we see correction in the stock price. Stock price is just one data point, and in the stock market, if you rely on just one data point to take your investing decision, it becomes very risky. So, but then this is an important data point, and it does give us an indication that there has been some correction in these two stocks. So what we are going to do, let's have a look at a more powerful insight, which is price to book. Now I'm here at price to book ratio, and then I'm going to sort this, and we see that New India Assurance Company and General Insurance Corporation of India, these two are the cheapest stocks because their other stocks are trading way above their book value, but these two stocks are trading below their book value. One of the questions that should crop up is, why is it that these two stocks are trading below their book value? And one of the reasons is that the return on invested capital, ROIC, for these two stocks are not attractive. If you look at the ROIC of 5-year average, ROIC of New India Assurance Company and General Insurance Corporation of India, this is 5% and this is 8%. These are not really attractive ROIC, and this is one of the reasons that these two stocks are trading below their book value. But if you look at the historical valuation, we see that the 5-year average of General Insurance Corporation of India is 1.4x and it is 1.25x. So I have spoken about the historical valuation, the context of historical valuation, and we see that these two stocks are trading way below their historical valuation. It is very much apparent if you look at the historical valuation that these two stocks are cheap because they are trading way below their historical valuation. But then we need to validate also. We need to understand why are these two stocks trading at cheap valuation. Is it because of market sentiments, or because there is something wrong in terms of sales growth or profitability. So that we need to validate. So first let's do the validation for General Insurance Corporation of India, and let's look at the sales thing first. So let us have a look at the sales growth. So in terms of revenue, in terms of sales growth, from 13,000 crore, it has almost tripled to 39,000 crore. So we see that there is a semblance of sales growth. Now let's have a look at the net profit. We don't see any growth in the net profit. So here in 2014, it was 24 around 2,400 crore, but here in 2022, it's around just around 2,400 crore. If you look at that 9-year data point, we see that there is no growth. There is no growth in the net profit, and that is again one of the reasons that it may be trading below its book value. Now let's have a look at the ROIC, the return on invested capital. So just see, it is, so we have at least 1 year where the ROIC is negative, but if you look at the 3-year and 5-year average, the ROIC does not appear to be attractive. Now let us have a look at this chart here. It's going to give us the 5-year median and the 5-year average. So here if you look at this chart, we see that of course there is a dip in the valuation here. Relative to the historical valuation, this is trading at a cheap valuation. So we have seen the sales growth part, we have seen the net profit part, we have seen the ROIC part, and we have also seen that chart price to book. But how will we value it? Now the valuation, how would we know what is the fair value? So we need to find out the fair value here. So for that I am going to come here, and I need at least couple of big data points out here. One data point will be what will be the net profit forecast for the next 12 months. How much the company can earn in the next 12 months. So again, I need this data point here. So I'm going to again go back here to this table, and I'll try to look at the base case. I want to find out the base case. What is the base case here for the net profit? So then, so we see that 2,400 crore, around 2,800 crore, 2,800 crore, 3,600 crore, 3,100 crore, 2,700 crore. So we have a bad case here also. It's negative out here. It's loss. Then we have 2,000 crore, and then 2,300 crore. So generally I believe that this company will make around 2,400 crore. So I have that base case with me, and I will go and I'll put this base case out here. Now it is very important that we are super conservative with the net profit part. We need the base case. So I have put this thing. Now the long-term growth I am going to put, so this is the terminal growth out here. So I'm going to put it 0 because there is no growth. And this is the simple valuation. We are just having the 1 year ahead forecast. And I have put 2,400 crore, and let's look at the valuation out here. Now we get this forecast. So the EPS is around 13 rupees. The ROE is 6.67%, which is not attractive. And if you look at the fair price to book, it is 0.89. And the fair market cap according to this estimate here should be 32,000 crore, and the fair share price is 182 rupees. But this is just a fair estimate. Now I'll put this thing very strongly here. This valuation out here is just a fair valuation. We have to be very careful with the fair valuation. So fair valuation is something that we need not pay as investors. We want some discount. Even if we know that the fair value is 100 rupees, we want to see some discount, and we want to always be eager to buy at a big discount relative to the fair value. So even though the fair value is 182, we want this part here, the margin of safety. Margin of safety is extremely important. Margin of safety is extremely important because you would not like to pay a dollar for a dollar. You want to pay say 70 cents or maybe 50 cents if the stock is not doing well in terms of growth and in terms of ROIC. So the greater the uncertainty, the more margin of safety you'll require. Now, if you look at the margin of safety section here, this is telling you that the margin of safety is when you're buying below 0.62 times book and the discounted price is below 128. So this is the margin of safety, and this is a probability meter. It's telling you there's at least around 80% chance that this is going to trade above this valuation, this price to book, and this share price. And this is how you can look at the fair valuation and the margin of safety. Just a very quick point, that whenever you're doing this valuation, just don't go with the fair valuation. You should always build in a semblance of margin of safety. You want to be safe in the market. Now the second stock is that we are going to look at is New India Assurance Company. So I have come here. I need this data point here. What is the net profit forecast for the next 12 months? So again, I'm going to come here and look at this data point. So there we go. Yes. So you see around 900 crore, 800 crore, 1400 crore, 900 crore, 1000, 2100, 600 crore, 1400 crore, 1600 crore, 200 crore. So mostly I'm just making a base case here of around 1400 crore, and that is what I'm going to put here. So I'm going to put 1400 crore here, and I'm not going to give any terminal growth to it. It's going to be 0. And then I'm going to do the calculation here, and we see the EPS forecast is 8.5 rupees, and the ROE is bad here, is 5.43%. And if you look at the fair price to book, it's telling us 0.72 times book, and the fair market cap is around 18,600 crore, and the fair share price is 113 rupees, and the discounted price to book is 0.5 times book, and the discounted share price is below 80. And it's telling us, the probability meter is telling us that there's a 90% chance it's going to trade above this price to book and above this this share price above 79 rupees. So this is how you can look at the fair valuation and the margin of safety. Now again, I'll put it very strongly here that margin of safety is extremely important here. We don't have to overlook it. This is something that you want to focus on. But this is just now what we're going to do. We're going to build in more validation out here. How are we going to do that? We are going to look at this chart here. It is giving us the price to book ratio for more than 2 years. We have more than 2 years data point, and the price to book chart is out here. So what we're going to do, we have selected price to book. We have to select mean. Let's have a look at the mean. What is the mean valuation in the last more than two years? And then we're going to see 1 standard deviation, 2 standard deviation, -1 standard deviation, and -2 standard deviation. Why I'm doing this thing? I'm doing this thing because I want to have a look how the market has given the valuation to this stock. We may have done one valuation ourselves, but that is just our valuation. The market may never agree with our valuation. We have to always look how the market has valued this stock here. Okay, so there are quite many data points out here. But then if you just observe this chart closely, you will see that the valuation becomes very much unstable once it starts trading above 2 standard deviation. You see here, right? You see here, it's not been stable here. It has mostly come down below this level. Again, here it's almost touched, but then it has again come back to the mean level, at least below 1 standard deviation. Now, the interesting part here is that the valuation does not become unstable merely in the case of plus 2 standard deviation. It also becomes unstable when it starts trading below minus 2 standard deviation. You see here, so it has breached the minus 2 standard deviation out here. Now, it is very much likely that the valuation will again become unstable when it starts trading below the minus 2 standard deviation, and it is also very likely that we are going to see a reversal out here. It will revert to the mean. So this is another layer of validation that you can build in. So we have seen the fair valuation part. We have also seen the margin of safety part, and this is another validation that you can do here. So if you look at the chart, we see that relative to minus 2 standard deviation, the stock is cheap. Now let us have a look at the chart for General Insurance Corporation of India. So I am here at more than 2 years of data point, and I have selected price to book, and I have selected mean. I have selected 1 standard deviation, 2 standard deviation, minus 1 standard deviation, and minus 2 standard deviation. And we see here that it has breached the minus 1 standard deviation. So we see that it is cheap related to minus 1 standard deviation, but it's yet to breach minus 2 standard deviation. But given the chart and the data point, it appears very unlikely that it's going to come to this level. Okay, so we had a look at two stocks in the insurance sector that appear to be cheap. But I will throw in a word of caution here that we need to be careful about value trap. A stock may appear to be cheap in terms of trading below its book value, a low PE, a low price to sales, but we need different layers of validation so that we are absolutely certain that the stock is cheap because of market sentiments and not because of there's some problem with the fundamental. Okay, thank you very much for watching this, and do well, be safe in the market, always look for margin of safety.